Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Welcome, Jeremy.
Thanks, Damo. Hi, everyone.
So this is an episode on what's happening across the Australian property markets. So if this is something that you want us to do on a monthly basis, leave a comment, maybe hit a like on the YouTube channel, and I guess if it gets the views, we'll do this consistently. Jeremy, what do you think?
Sure, happy to.
So the idea here is every month we release the data, around the 6th of every month, typically?
About 6, yeah.
And I spend hours going through the data, seeing what's changed. So I thought it's a good idea to maybe all our audience and listeners provide the value and show them what we are seeing in the data. And let's get started. So the housing markets across the capital cities. So typically what I'll do is I'll go into our Suburb Data platform, and we've got saved searches, and one of them is the capital cities search. So typically we'll look at certain data points. Obviously, it's a bit tricky to see what's happening unless you're on the ground, but it takes a bit of time for the data to sort of flow through. So I think the next 1 to 2 months, it's going to be flowing through nicely with all the potential CGT and negative gearing changes that are going to take effect. Definitely, I think we're going to start seeing that within the data, which will sort of go through stock on market, days on market, and other sort of metrics. But overall, for the month, I would say that let's have a look over the last year. Most markets have picked up. If you look at all the significant urban areas, obviously, Darwin, Perth are the higher flyers. You got Hobart, Brisbane, Adelaide also that have had pretty good runs, and then Canberra, Melbourne, Sydney sort of lagging. Again, there are sort of pockets in pockets. We know certain parts of Melbourne are obviously doing a lot better than others, but you can see here over the last 12 months, Perth has been the flyer.
25% is extraordinary, isn't it? And there's still more to come.
Yeah, I've shortlisted this by the DSR3, which is our sort of flagship metric. So Darwin still is at the top, and then Perth not far behind, considering Perth has had around 100% doubled in growth over the last 5 years, hence why the market cycle timing number is pretty much what the third lowest behind Brisbane and Adelaide. Because they've had such big runs, the market cycle timing is a lot lower. Again, we mainly look at the DSR3 metric, but it is one of these things, if you are taking a bit of a longer term view on your investment journey, you might look at potential other markets with better market cycle timing opportunities. Do you have anything to add on that?
No, but I just think 100% in 5 years for Perth, the city as a whole, is amazing. And also Brisbane,
and
pretty
Adelaide.
close, 95%. Adelaide, not as bad as it either. Not bad either, nearly 90%. I mean, 5 years, I can just remember when I first started getting into property, and the expectation of having 10% per annum for just a couple of years would have been fantastic. But seeing things like 20%, 10 and 15. So don't expect this sort of thing will keep going forever. If you're a novice property investor, these have been pretty good times recently.
And with the federal budget proposed changes, would you be buying right now?
Just did.
Okay, good, true. Again, okay, it's fair enough. But that was sort of before, you were in the process before the changes were happening.
I hadn't signed a contract until after, 12th of May.
But it hasn't slowed you down, right?
No. But I can understand the cash flow considerations of the typical investor for these changes. But
I don't think there's anything wrong with waiting a couple months just to sort of see what's going on, because we are seeing some interesting points in the data which we will go through, but I don't think there's any rush at the moment. I know everyone's going to tell you there's always an opportunity, but I think you don't need to rush right now.
Yeah.
And we'll see that in the data. Sydney, Melbourne and Canberra are actually starting to see some good improvement in the DSR3 score as a whole. Obviously, again, like you've got already like good DSR3 markets within sort of certain pockets. For example, in Sydney, I don't think Campbelltown's too bad. Pockets of Melbourne are pretty good also. But the MCTs are the ones that are really high for Canberra and Melbourne, just because they've been lagging compared to the other markets. Vacancy rates remain really tight across pretty much everywhere. We know that, below sort of 1% vacancy rates. So rental is very, very still challenging for a lot of people.
Yeah, and probably going to get more challenging. I can't see anything in these federal tax changes that's going to alleviate that. I mean, the only option for renters is to pursue the supposedly more popular rental properties in the fringe suburbs where there's, these greenfield estates and new housing. But I mean, what happens to the majority of the rest of Australians? You'll have the occasional established property sell, more likely to a owner-occupier now than to another investor. So that means there's just going to be less and less rentals available in established areas, which means vacancy rates are going to go even lower and rents are going to go up even faster until eventually you get cash flow positive property in established areas, and that'll bring back investors into the market and everything is restored back to balance.
And I think, supply's picked up a little bit. So if you look at that stock on market percentage number, which we'll go through shortly, but it's definitely picked up a little bit, which is what we expected. We only had, maybe a couple of weeks after the announcement on the federal budget, but stock has picked up as days on market. So that's for houses overall. Now let's move over to the typical value change. So we use typical value. I know that Catality use their hedonic index. Is that right, Jeremy?
Mm-hmm.
So a little bit different how we, use a typical value. But overall, there was about pretty much a flat market over last month in May. So Darwin
overall,
picked up.
But, look at the differences from top to bottom there. That we're talking about the rightmost column on this slide. So Sydney backwards 2% in a month is quite significant, 2.5, 2.2 for Melbourne, but then ahead by 2.4% Darwin.
And like I said, I think with a lot of this, we should maybe even look at it from a yearly point of view. Might be good too, instead of just looking at that 1 month. But that typical value has definitely fluctuated, definitely. But overall, it'll be interesting to see what happens next month when we get a full month's worth of data again.
Yeah, full month. Yeah, and even then, that's not with the new tax laws in place. It's just still, at the time of recording, working its way through the upper house.
I think it's important, as I said before, you got Sydney, Melbourne and Canberra and let's say Adelaide all gone backwards, but there are pockets that have gone up too. So it's not like they're bad areas to invest in. There are markets that have done well.
Yeah.
Also,
yeah. I mean, Sydney's got 700 suburbs. Melbourne's got 500. So yeah, there's pockets that are still very hot and others that are cold.
And it could be that sort of higher end too, because that typical value is a little bit higher. For example, for Sydney and Melbourne, maybe you can feel it that little bit more. Stock on market percentage. So if we have a look, it's picked up everywhere. Pretty much Darwin's picked up pretty quick in the couple of weeks of data that we had. Adelaide, Perth, Sydney. Again, I wouldn't look at that change so much. If we just look at Darwin as an example and went up from let's say 0.5% stock on market to 0.7%. Don't have the exact dwelling count increase, but you can clearly see that's going to be a trend in the coming months. There's going to be more stock available.
Yeah, and there's nothing worrying about that because 0.5% stock on market is chronically low. So 1% would be about normal for percentage stock on market. So you can see towards the bottom of the list, you've got sort of about halfway, isn't it, is about normal. 0.9, 1, 1.1, that's all normal. But 0.5, coming up from 0.5 to 0.7, yeah, it's a 40% change, but it's still too low. So there's still a shortage.
When you go to the granular level and look at, let's say, a particular suburb, let's just pick a suburb off the top of my head. Let's say Docklands in Melbourne as an example. I haven't looked at the data recently, but that stock on market for units would be most probably quite high because they've got a lot of off the plans and a lot of listings there. So that's why that stock on market would be higher. It could be 4, 5, 6%. In an estate area, same thing. You're going to have a high stock on market. But even though a market might have, if you just look at data purely and it's got, let's say, a 5% stock on market, it's in a greenfield estate, they could just be all land and house packages that actually haven't been sold. So it could actually be really tight on the ground, but these properties haven't been built yet. So there could be still price pressure in these greenfield estates.
Yeah, you know that it's possible to have over 100% stock on market.
Yeah, so
Yeah, I think I told you
if
before.
it's like a new suburb or a new
Yeah.
estate,
So the way it works is you count the stock on market as all the properties that are currently listed for sale. But if it's off the plan, they don't exist. So the number of dwellings in that location might actually be less than the number of dwellings that are for sale.
be quite rare, but it'd be definitely
It's
new
very
estates.
rare, yeah.
Days on market, again, picked up everywhere. As I said earlier, we haven't, we're just feeding through the data up until the end of May. But yeah, this is clearly what we're going to see, an increase in days on market of around sort of 6% overall. Hobart, Sydney, Canberra, Melbourne, but Hobart but they're not massive changes, right? Like 34 days on market for a property to 39 days.
Yeah.
Still very tight everywhere.
It's noticeable, but it's not alarming.
They're actually really tight across the board, right? Like days on market is low everywhere.
Yeah, when you normally expect, say, 2 months, say 60 days, yeah, it's tight everywhere.
Vacancy rate. So vacancy rate, we're very tight in Darwin. We went from 0.6% vacancy down to 0.3%. So a very strong market from a rental aspect and a yield aspect.
Yeah, that's quite confusing to the rhetoric we hear in the popular media, the opinions that it's a dominated market. So if you have, let's say you've got a suburb in Darwin that's got 500 houses, and let's say 100 of those are landlord-owned houses. Now, if one of those is vacant, you've got a vacancy rate of 1%. Here you're talking about 0.6%, meaning that it was only on the market available for a very short period of time. If it's an investor-dominated market, and you have, say, 5 houses sell in a month, and let's say it was all investors, like completely dominated, then one of those is likely to already have a tenant. The other 4 have to go on the market. So you go from 1% vacancy to 5% vacancy. So vacancy is very sensitive to investor-dominated markets, but you can see this has actually gone down. So it still cannot be investor-dominated.
The other point I wanted to mention was with the typical values with all the markets that we looked at originally, like there might be strong DSR3 markets, for example, if we just go back a little bit, but like let's say, in Canberra or Melbourne or Perth, wherever it might be, it's really price point dependent. We're looking at everything here, right? Like all the SA3s, all the suburbs bundled into one with this typical value. But as an investor, you need to work out, well, what's your max price point? Like 700,000. Okay, great. What yield are you after? And then you make a decision, you purchase, hold, and you hold that investment for the longer term if that's your strategy, which is most people's strategy. But just wanted to point that out, that that's like typical value is a big thing, because in Melbourne you're looking at close to 1.2 million. Do you buy a house in Melbourne somewhere on the cheap, or do you go into Perth, townhouse, something a lot cheaper potentially? They're the decisions that you need to make, right? But that market cycle timing is a big one, where it's just had such a big run, and a lot of people don't really like buying into these markets that have a huge uplift. Not to say they're not going to grow, it's just the probability is a little bit lower, right? If you're buying now for the next 5 years, which one's going to outperform? That's the big one, right? Days on market, we looked at vacancy rate, rental growth. So rental growth over the last 12 months, Darwin's picked up a lot. It's picked up by, it's about 15% rental growth over the last year. Hobart around 11%, Sydney 6%. So pretty much everywhere has had rental growth.
Yeah, I mean, and to have a couple there in the double digits, so most people expect it to go in line with inflation or in line with long-term capital growth, which would be around 6-7%. But yeah, the rental crisis is still clearly not over, with the possible exception of Melbourne and Adelaide.
Moving over to units now. So typical values for units. So Darwin, again, at the top overall with a typical value of around 430,000, and that yield is very enticing. Now, I know that a lot of people are going to argue the fact that the insurances are a bit more there, but tell you what, I think that yield's going to be very promising to a lot of investors, especially if your budget's around that $400,000 range.
Yeah, it's amazing, isn't it? State capital under 500,000. I mean, the next closest is where Hobart, was it? 592, just under 600,000. But look at the gap between Hobart and Darwin. As far as state capitals are concerned, Darwin is out on its own it's just incredibly cheap.
Well, the thing is, the vacancy rate's the tightest across the board, and stock on market is actually a little bit higher than Adelaide, but it is Adelaide and Brisbane, but it's like, again, really tight there, and market cycle timing strong. Had about 21% growth over the last year, as the Perth and Brisbane around that 22 and 21%, so high flyers in the unit market. But again, that Brisbane and Perth growth over the last 5 years have outperformed houses, 101% and 112%. So massive. So again, depends on the view that you're taking, but market cycle timing is definitely, there's opportunities, I believe, in, Sydney, potentially Melbourne, Canberra, by the looks of it too, if you're looking purely at MCT, market cycle timing.
Yeah, and market cycle time is just one metric. It's included in the DSR, so you can't ignore all the other metrics, which could be in contradiction to market cycle timing.
Yeah, but I think Melbourne was actually the biggest mover. So there's been a couple of adjustments to the DSR3 algorithm, but I think that's pushed Melbourne up a little bit more with the more data set, right, Jez? What else have we got here? So we're looking at typical value. So again, Perth, Brisbane, Adelaide were the main movers of the month. Canberra sort of even, as was Melbourne, and then it looks like that interesting Darwin come back a little bit with Sydney and Hobart. But again, that could be due to maybe some sales volumes, all right?
Yeah, it looks like it's a little bit more even than with houses.
Definitely.
The extremes there, 1.8 at the top versus 0.7, negative 0.7 at the bottom.
But definitely, it's a bit more closer together. And stock on market, again, pretty much very uplifts pretty much across the board. The only place, Hobart and Adelaide's stock on market actually declined. So that's why I'm looking forward to next month's June's data to come through to see, because we get a full month's worth of data.
Since the announcement.
Correct. Anything to add to the stock on market there, Jeremy?
Just the significantly mixed results. The polar opposites there, top and bottom, there's a 50% difference, up 25%, down 25%.
It's only 0.1 though, so it makes it look very skewed when you look at it. That's the challenge.
Yeah, off a low base.
Days on market pretty much lifted everywhere as we expected. So it's slowing down for sure, similar to what houses are happening too. Besides Darwin and Canberra come back a little bit, but days on market is sort of trending, which we'd expect, right?
Yeah, given the news.
And I think the other thing is a lot of investors or owner-occupiers, maybe lending strategies have also changed. They've had to go back to the lenders to do their refis. Vacancy rate, again, similar story, really tight. Like Darwin, 0.4. What else is quite low? Brisbane, Hobart, Adelaide, Perth, but 0.4.
Very small unit market, Darwin.
Very small. But what's the other one there that's maybe like Hobart and Brisbane? Very tight. The other thing I was going to have a look at was actually we did look at houses rental growth, and let's have a look at unit rental growth. So units again pretty much had rental growth across the board everywhere. The only double-digit one there is Darwin, about 11% over the last 12 months.
Yeah, so just that metric there of rent growth, that is rent that's grown over the last 12 months as a percentage. So looking at the top line there, Darwin, so it's gone from 5.1% to 11.7%. Bear in mind, though, that unit markets in Darwin, it's a small sample size. So the 6.6% is a change from month to month, but the 5.1 and the 11.7 is the change from the same month the prior year.
Correct. Yeah. So the year, so that 6.6 is the difference, like 11.7 to 5.1 over the year. So the one that I'd be looking at here is most probably that end value, which is saying that over the last 12 months has been 11.7% growth.
Yeah,
That's the key number.
Yeah, the second last column.
That second last column. And I expect that rental growth to continue to push with the low vacancy rates.
Yeah, it's not going to get any better.
Key takeaways. So I think, as I said, like every market there's always markets within markets, but again, it just really comes down to your circumstances, the buffers that you've got in place, any goals that are coming up, could be car expenses, moving homes, whatever it might be. So I think really dial in on what your budget's going to be. And I think yield's going to be a big play for a lot of investors, potentially.
For the established.
The house supply has lifted, and so, as we know, days on market's obviously increased. So I expect that to increase a little bit more. And I think units may be holding up a little bit better than houses due to the fact the price points. I think units are going to be quite popular because they're a lot more affordable.
Yeah, no, I noticed in Sydney there's some great opportunities for units for Sydney buyers who are priced out of the market when you're thinking 2 million, 3 million for a house. I think it was Punch Bowl. I saw you could buy it's an old two-unit bedroom, two-bedroom unit in an old but small complex. That's quite common there in Punch Bowl, and it's under 600,000. And I thought that's extraordinary for Sydney.
That's
so
right.
Great value for money.
And there's more in that sort of western corridor because I know we've done a bit of research around there. So it really, again, it comes down to your budget. And if you're an owner-occupier in Sydney, you don't want to rent anymore and have your own place. I think there's definitely some opportunity in the unit market. So is there anything else, Jeremy, you want to go over?
Me.
Yeah, so I think if you like this, hit a like. If it's something that you enjoy, leave a comment and we can try and do this on a monthly basis and maybe a little bit quicker too. So as soon as we get the data, hopefully within a couple of days, we can get the content out to you because I think that's lacking in the industry at the moment. I think Catality do it. They take a bit of time also, but I think that's what we want to get to, right? Be one of the leading data providers where we can give a snapshot and any data points that you're interested in, we can bring to the audience.
Yeah, so let us know if this is of interest to you in the comments and like and subscribe.
Like, subscribe, share to the world. That's what's in the notes. Thanks for tuning in and see you in our next episode. Bye for now and take care.